Hi there, this is Helen Tarrant again from another here with our whole team. Wow, it's massive. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually going to share with you what happens, the impact of interest rate rises on resi versus commercial. So this way you get to see what the difference is and what you're buying through resi and commercial, and versus what happens when interest rate changes from, say, 3.5% to 4%, right? Where we're trending now is we're heading towards 3.5%. So there's no point us looking at, where we were at 3%. We're going to look at what's going to happen. So to by, say, September this year, we're going to be hitting about 3.5% in the commercial, maybe the commercial property space, maybe 3.25. So this is very conservative. And maybe in resi, you might get to 3%. So it's just a little bit different. And then we're going to look what's going to happen if 4%, which could be end of the year, beginning of next year, and what that impacts on your cash flow. So I want to share, I've done a little bit of a table so I can share with you, but I can also share with you the type of properties you're likely to get in this market based on resi versus commercial as well. So first up, I want to share with you what kind of properties you would get for something that's sub 1 mil. So I'm going to take you through some different properties. So let's say that, I'm going to share with you this table that I have, and we can go through it and I can share with you as I go along what kind of properties you're going to get. So this is my residential versus commercial property. So you can see that for 500,000, so let's have a look here. For 500,000, if the purchase price is 500,000, what you would get in this current market is an office space or a retail space. So it's going to be strated, it's going to be ground floor retail or office space with a really good tenant in there. You've got apartment or unit is what you're going to get in here. It's going to be a $30,000 in rent per year from your office or retail, and you're going to get gross rent probably somewhere around $400 a week from your apartment or unit, right? So that's unit with a T in there. And I think that didn't come through. Now, one of the differences between commercial and residential is that what's been paid by the tenant, what's been paid by the landlord. As you can see, I've set this out. If you're buying a $500,000 property, you're going to see that strata fees, water and council rate, management fees are the 4 large fees that are the difference between paying by the tenant or the landlord. You're going to see that your strata fees, which is typically about $1,000, $800 to $1,000 per quarter, being $4,000 if you're in an office space, potentially a little bit more, maybe 5,000, and apartment potential a little bit less, but I work this on $800 per quarter, and your water about $1,000 across the board, and council rates about $1,500 per. Now, the difference is you pay all of those outgoings as a landlord for residential, and the tenant pays for all those outgoings as a commercial, as a commercial landlord. Now, the difference is now we come to management fees. Now, proportionally, a large proportion of your tenants, and I would say probably 70 to 80% of your tenants pay management fees as part of their outgoings as well. They also pay land tax as well, but I'm not putting land tax into here. But you'll find in residential, your typical management rate is also higher because it's more fiddly, there's more contact. It's usually now probably somewhere anywhere from 6% to 8%. Some people have said they've been charged 9%, but I put in 6.6%, so quite conservatively, right? Now, on a $500,000 property, you can get LVRs in commercial up to 80%, which is $400,000, and you can get the same obviously in the residential side as well as the commercial side. Now, your deposit of $20,000 across the board. And your interest rates is, I put 2 here. I put one interest rate at 3.5%. So here I'm going to mark that as yellow, 3.5%, and then I would mark this as red. So this is what happens in the market as we go through. So at the moment, we're heading towards that 3.5%. Whether we're going to hit that at the end of the year or we're going to hit that in September, we don't know. It depends on what's going to happen with the interest rate rises, right? But of course, I also allowed for this particular property on both sides $1,000 for repair and maintenance per year. That's, sending out a plumber, electrician, needed to get something fixed, some drains blocked. In also the office space, let's just say there was special levy that needed to be raised. All of these things basically have left about $1,000 in both sides for repair and maintenance. Now you can see that at 3.5% on a $500,000 apartment, you are losing $1,272 per year. So I reckon that's what 20, let me work that out, works out to be, let's say 1272.8 divided by 52, that's about $25 a week, right? But you're getting a lot of cash flow from the commercial, right? For about 1368, that is about $263. So you're losing $25 or getting $263 per week. So depends on what you like, right? What you hold it for. Of course, we haven't done the depreciation on it, but if we do depreciation, both of them are going to end up the same, very similar as well. So what we're also going to see here is I'm going to highlight the red bit. So, you know, this is what happens if interest rate goes to 4%. So sometime, let's say in 12 months time, we're going to be at 4%. Some people think it's going to be earlier, but in 12 months time, we're going to be at 4%. And what that means is that where if you are holding the same property with the same LVR, paying interest only on it and not principal, if you're paying principal, obviously it's going to be a bit more, you are actually out of pocket about $63. So you've gone from $25 to $63 per week out of pocket when you own a residential property. Now, that's $500,000 residential. Now, that's fine when you have one property because that's about $200, $250 a month, right? But if you have 5 residential properties, you are out of pocket $1,000 per month, and that becomes starting to hurt, right? In commercial, of course, we've had a reduction. Instead of getting paid $13,680 from our tenants after all outgoings and mortgage, what we now have is you're getting $225. So 263, 225, right? So you are down $38. You're down $40 a week. So you're down $40 a week in comparison to being out of pocket $63 a week. So that's the difference, right? And that's why people will continue to invest into commercial. Instead, it's not sensitive to rate rises because you're losing $38 a week or in $40 a week, right? Yeah, look, it's not great news, but you know, it's better than losing $63, right? Better than losing an extra $40, right? So let's come down and say, look, what if you bought a property that is an office or a retail space around $800,000 and you bought a unit around $800,000? What would you get? Well, typically, if you bought a unit, you would get this property here. If you bought a unit that is a residential unit, and this is just a suburb in Sydney. So this is a property in Castle Hill, quite a nice kitchen, a nice lounge, quite new, nice bathroom. You know, you got 2 bathrooms, you live in a little courtyard. It's quite cute. It's quite a cute property. It's a property that has good sized bathrooms and everything, and is pitched to about $850,000. You probably can negotiate a bit, maybe get an $825,000, $830,000, who knows, a little bit, right? And this is sort of the layout of the property. It's neat and tidy, right? And so that's the kind of property you are going to buy if you bought a residential around $800,000. Now, if you were looking at a commercial property, this is the type of property you would buy versus a residential. So this is in an office building, and you can see that this is an office block. Very, again, neat, tidy, nothing to do. You get a couple of car parks and you get a kitchenette and pretty much simple set and forget type of property in, again, well-to-do suburb, very similar to Castle Hill type of demographics, 95 square meters. So let's have a look at how much the other property is that we looked at here. Oh, sorry, here. Sorry, I'm looking at the different ones. So here, let's have a look at how many square meters that is. Doesn't quite show, but maybe in the floor plans it will show. Let's have a look. Doesn't quite show how much a floor, doesn't quite show. Let's have a look. Normally it talks about it. All right, but look, it doesn't say, it's probably give or take similar to that to that. Maybe it's a little bit smaller, maybe it's 70, 75 square meters, but very, very similar, right? A property like this is a little bit this is probably going to be a little bit cheaper than 800, but it's typically the rent is going to be higher than that, and you're going to get it for about and he's going to get about 6% yield is what we're looking at in terms of a Queensland office property or a Melbourne office property, close to that 6% yield, which is again what we did the numbers on here. We did the numbers on it here. So at 800,000, you get $48,000 in net rent. You get $31,000. So you probably rent that property, the one we saw in Castle, for about $600 a week, which makes it $31,200. Again, outgoings paid by the tenant, outgoings paid by the landlord in the residential space. And now we look at the same management fees. And for this purpose, the tenant's not paying management fees. So you as a landlord paying management fees, you've got this at 80%. So again, at 800,000, you can still get 80% LVR loans depending on your situation, or alternative, maybe potentially 75% or LVR loans. So you can get higher LVR loans. You got 20% deposit, and we're looking at interest rates of 3.5% to 4%. So let's look at where the current interest rate is. So the current interest rate sits at 3.5. So where that is now at 3.5, we can see that it's about 22,400. This is interest only on the loan itself, right? It doesn't account for paying or servicing your deposit. If it's an equity drawdown, you're going to be more negative in terms of your cash flow in the residential sense, but you're going to have a little bit more positive, a little bit less positive cash flow in the commercial sense. But let's have a look at that. 22,000. I've also added for this particular one $2,000 in the commercial space for repairs and maintenance, and only $1,000 in the residential. So the residential a little bit cheaper to maintain, right? And that just adds a bit of a buffer for it, right? So here I want to share with you here that that's what you're going to get at the moment. You're going to be minus $1,259, and you're going to be up $1,488 in terms of commercial. So if you bought that right now, you would be $24 minus $24 a week in terms of your residential, and then you would be up about $413 a week in terms of your commercial. So obviously very, very different, right? And then now let's look at what happens in terms of if it goes up to 4%, right? 4% here, we're starting to really see the major differences. Again, we're seeing major differences, not that huge difference from what we're seeing here above. Here we're seeing, our cash flow drops to $13,400. So it goes from $415 to about $400 to about $260. So there's a bit of a drop. So per week we are dropping again. We're losing around that. We're probably losing a bit over $100, $120 or so, and we're seeing losing $66, right? So it's just a little bit of a difference there, a little bit of difference. And I actually think that maybe, let me just recalculate that. So 48,000. Normally that we're paying the outgoings on this one, so not all the outgoings, but just the management fees, and then we are taking that, and then we're minus 2,000. So it's actually, sorry, I've got that wrong. It's 18,288. So what we're seeing here is 18,288. So we've gone from 400 something, so we're losing that $60. So you're losing $60 either way, if you're resi or commercial, right? So the commercials obviously comes off the cash flow, so you're getting less cash flow. Resi, it's out of your pocket. So that's the main difference. So now let's look at something at 2 million. So we're going up. We've got 500, we've got 800,000. We're going to go to 2 million price bracket. Now this is where you buy a freestanding house versus a commercial property, which is a freestanding building or a warehouse property, right? Probably in regional. And I've done this again on about 6% because I want you to be realistic of what you're seeing in this current market. So let me show you what you could be buying in Castle Hill right now for about $2 million. So here, again, we're just taking the suburb, and I just wanted to share with you. So this is a property in Castle Hill, quite a nice house. You can see that. That's a nice house. That's about 1.7 to 1.8. I've got another place here, which is a property that you can see is 2.2 to 2.4. Differences in renovation, differences in area as well. So they're nice suburban houses. This is what you're going to get, what type of house you're going to get for around that 2 mil mark. So we've seen 1.7, 2.4. This is what the kind of things you're going to get. Now, what are you going to get in commercial? So if we go regional into commercial, this is the type of property you're going to get in commercial, in regional. So you're going to get something that's large formatted warehouse. Look, this is not the most neat and tidy property. You probably need to get rid of a lot of those trees. There needs to be a gym tenant in there, Gym City Gym, so you can see the karate, but it's got land. Of course, you can repurpose. It's got some, it's straightforward and really, really simple type of property. So you've got a couple of tenants in there with some parking. You probably still have land and upside that you can actually start to land and upside that you can definitely like use and utilize in the future. Let's go down and read. So this is a property looking for offers over 2.1 million. So, you know, it's within our range. Lots of large land. And we're looking at, you know, own, occupy, reposition, redevelop in Gympie Central. So obviously this property, this tenant's not there for the long term. So it's something that, you know, once you have the tenant in there, might need to repurpose it. It's an upside property. But it doesn't mean that you can't renegotiate the lease later on. So it's all about how you repurpose and renegotiate the lease on something like this. But if there was a tenant in there, let's say the gym tenant for another 3 or 5 years, this is still similar to the type of property you would be getting. So just a straightforward warehouse, freestanding building on multiple levels, that's the type of property you'll be getting. So what does that look like in our figures? So let's have a look at that. So here at 2 mil, so we've got the purchase price. We've got the purchase price now at 2 million. And again, we've worked this out on 6%. And we've worked a house that now, so the rentals in a house is probably somewhere around, sorry, I put 1,400, not 14,000, about 1,400 per week. Obviously, some of them are less. Some of them may be around 1,200 or 1,000. So that might be, you know, it might be a little bit less, but I've just put it at 1,400. Nice renovated house, 1,400. Outgoings paid by the landlord if you are buying residential. Outgoings paid by the tenant if you are owning commercial. So obviously in this circumstance, we said the management fees, both sides pay for the management fees to be comparing apples with apples. Now, the only difference here is in commercial, you're going to see that at this level, your maximum LVR is probably 70, 75%. You're not going to get 80%. In residential, you can still get 80%, but you know, you're going to have to show higher levels of being able to service that at 80%, or you're going to have lots of equity. So I put 80% here and 70% because that's your maximum leverage without paying for lender's mortgage insurance, and also in commercial, what's realistic really for this property in terms of a loan on a full documentation loan. Now, deposit 30%, 600,000, 20%, 400,000. So it's going to cost you a little less to get into a residential than it is a commercial. But of course, I haven't accounted for cost yet because cost is relatively the same across the board anyway. So now we're looking at the interest rate. So we've got, we've got interest rate here at 3.5%, 49,000, and on the 1.4 and 56,000 on the 1.6. So your cash flow, you'll see that your cash flow actually, by owning a house in Sydney, is actually positive by 2,500, about $50 a week or a little bit less, and $60,000 positive, well, way positive in commercial, sort of the average salary almost, at 3.5%, right? But if the interest rate just went up by 0.5%, so we're looking at interest at 4% here, went up by 0.5% to 4%, then what the significant difference is that you're still positive in commercial, you know, less $7,000. So you are sort of out of pocket $80, $90 a week, but you are then out of pocket $50 a week. You've now reversed from something that's positive 2,500, you're now negative 2,500 in the residential space, which now instead of collecting $50 a week, you're now you know, having to shell out $50 a week, right? So for most people, that's $100 loss, right? And that's $400 in a month. And if you have a couple of these houses, it's starts to add up. And again, this is why commercial property is not as sensitive as residential in terms of the yield compression. And most people think that just because interest rate has gone up, you should now get more returns in your commercial properties, which is not going to happen. It's not going to happen because supply is way lower. It's never been so low in the commercial property space, and demand is at an all-time high. So you probably have 2, 3, 4 times demand to every property, which makes it so much harder for you to nab a deal at the right price with the right yield at, very high above market prices at a high above market yield. Absolutely, you can do the deal, but you're overpaying for it, right? So I guess in some ways it doesn't matter for a lot of people if they're overpaid for a commercial property because they can see the cash flow. And if you're coming from a residential space, it's easy to make that mistake, which is again why you would engage someone like myself and Unicorn Commercial Property to help you work through it and know that you can pay the correct amount, the correct yield, and getting the correct cash flow for that particular property. So I hope this has been really helpful for you to look at the different returns, right, as the interest rate moves and interest rate goes up, because it's important to match up residential with commercial so that you can see what kind of cash flow you're getting. And of course, there is the growth in the background we haven't talked about. If you're buying in metro areas, you're going to find that relatively, residential, you're still going to get a little bit more growth than commercial. But what has shown in the last couple of years is that commercial growth has really come along quite a long way. And now with sensitivity in the market of interest rate rises, and that's going to bring the value of some residential properties down, you'll find commercial, because it's not that sensitive to interest rate rises, will continue to grow. And that's why commercial property cash flow is actually going to continue to grow even when residential has stopped. And that's historically what's happened as well. So again, comparing apples to apples is really important. So that's really important exercise for you to do when you're looking at whether you want diversification in your portfolio, whether you should consider comparing residential versus commercial in terms of investment, whether you should consider diversification, whether you should be considering that, cash flow is really going to be more important for you right now compared to having something that's negative, or whether, growth is still important to you, right? So a lot for you to think about. Again, reach out to us if you want any of these things clarified. Reach out to helentarrant.com, unicorn.com.au, and let's jump on a strategy call. Let us help you build a financial free future through commercial property. So through lots and lots of cash flow, right? So join us, jump on a strategy call, and we'll see you on the next video. Bye for now.